All right, welcome back. This is Jared Passy with lots of pips, and we're looking into the placing trades piece of our section here on pairs and trades. The basics involved in placing trades in the foreign currency market. And let's move in and see what we've got here. First of all, placing trades is how you make money in the currency market. There are different types of trades. So here's some of the terminology to understand. The terms long and short are used very often. Long means that you're going to go in favor of the base pair, which is the left-hand side of the pair. So if I'm going to go long, I'm expecting this to climb up the chart from the bottom of the chart up. So if I'm going to go short, then I'm expecting it to go in favor of the quoted pair, which is the pair on the right. And that means, like from here, I would like to have gone short because the chart moved down. I would like to have gotten in and ridden this trade while it dropped off in my favor. So long means you're expecting the base pair to gain or the chart to climb. And short means you're expecting the quoted pair, the pair on the right, to gain in value over the base, and you expect the chart to drop. So if you're going to go long, it's going to go up. If you're going to go short, it's going to go down. You can trade in either direction. As I just specified here, you can trade and expect it to go up or down. All you have to do is say, I want to buy, which means it's going to go up, or I want to sell, which means you expect to go down. Now, a lot of people confuse the buy and the sell because in stocks, to buy, you get into the trade, and to sell, you get out of the trade. Well, you don't do that in the currency market. So I've had a lot of students that have messed up on some demo accounts as they start buying and then they start selling to get out, but all they're doing is adding more trades in the opposite direction. So what we do is we buy if we expect it to go long or up, and we sell if we expect it to go short or down, and we close when we want to get out. So buy or sell gets you into a trade, and then closing that trade is how we get out. We close it at any time. Now, another thing we have to pay attention to when placing a trade is the spread. Now, with most brokers, the only cost of placing a trade is the spread. The spread is the difference between the bid and the ask price on your pair. Okay? On each pair has the bid and ask price, and the spread is the difference. Now, every time you place a trade, you'll start out in the hole a few pips just to pay the spread. Right? The spread varies from each pair. Each pair has a different spread. Like the euro US dollar might have a smaller spread or less of a cost to get in than, say, the pound yen. But once you've made up the spread in your trade, the rest is pure profit. But you just got to remember, every time you're going to enter a trade, you're going to end up in the hole just a little bit, and you have to make up that spread before the money's yours at the end. Okay, let's talk about leverage and margin. Leverage is the ratio, and margin is the ratio of money required to control a part of the Forex market. The broker holds $200 for every mini lot you trade. That's $2,000 for a standard account. So it's $200 for every mini lot you trade. And that's on a 50-to-1 leveraged account, which is what the maximum the brokers can offer you. Whatever the broker is holding is called a used margin. Now we're just kind of going to get an overglow glossy view of this. There's quite a bit to learn about this margin and leverage stuff, but we're just going to do a quick so you got an idea of kind of what's involved. But whatever the broker's holding in your account is called the used margin. Okay, whatever's left over after the broker holds the number of account is called the available margin, plus or minus your open trades. All right, so here's an example. Let's say John has $10,000 mini account with 50-to-1 leverage. Okay, John places a 10-lot trade on a standard account. Oh, this is a mini account. 10-lot trade on the US dollar euro. Okay, for every lot they're going to hold $200. So for 10 lots, he's going to hold $2,000. The broker's going to hold $2,000 of his $10,000 account. They're going to hold that. They're not going to spend it. They're not going to keep it. They're not going to give it to their dog. They're going to hold that on the side just to have that to be able to make sure you have enough money to place that trade. Okay. Now, John has an available margin of $8,000. Okay. Remember, plus or minus your open trades. Okay. John starts out, because of the spread, down 2 pips. So he's down 20 bucks. Okay, these are $10, or down 2 pips. So he actually has an available margin of $79.80. 2 times $10. $10 a pip because he's placed a 10 lot trade. He's down already. He has an available margin of $79.80, and so that is what is going to be available for him to trade up and down on his account. That's his available margin. Okay, when the trade is closed, the used margin is returned to his account. Okay, so this $2,000 goes back into his account, and if he made 50 bucks in the account, he'd have $79.80 plus the 50 bucks plus the 2,000 that they held, which is a used margin, would make him so he made, 50 bucks in the account. Anyway, that's kind of how leverage and margin work. Let's talk a little bit about entering trades. Okay, the market, there's different types of ways to enter the trade. First of all, there are market orders. These are trades where you'll get in, you see the market moving, and it starts taking off, and so you enter a trade at whatever the market or the price is. So it's fluctuating, you catch it. Just a few pips ago as it was climbing up here, you got in. Okay, so a market order, you'll get in and then you'll ride it for a while and then you'll get out on a market order. You can click the same way. You can get out on different types of orders than you can get in, but this is an example of a market order. So we're getting in at the price we want to, right when we see the chart, and we're getting out right when we click the button, we're out. So that's basically an example of a market order. Now, a limit order is when we have a trade that we say, let's see, now this is another example of a market order. So we're going to get in here and we're going to get out, we're going to click the button here. A limit order would be like a double bottom trade, which is a certain strategy we'll talk about, where the market drops down, hits here, and comes back up. You expect it to hit there again and bounce. Okay, so you got to connect the word bounce to your limit orders. It's going to come down, hit your order, and bounce, and then climb back up. So we're expecting it to change direction, and we want to get in the new direction after it bounces. So this is a pending order. Limit and stop orders are pending orders to say when the future hits a certain price, get me in. A limit means you wanted to get in the opposite direction it was moving to get to that price. And so as this comes down and hits that order, we want to get in. And so it didn't hit it here. It took a little while. Triggered us in here. And then we got out up here. So that's a limit order. We expect the market to bounce off of a certain price barrier or something and then head in the other direction. The other order is a stop order. And the stop order is if we expect it to break through a certain barrier, we want to get in after it breaks through a certain barrier. So let's say it's 11 o'clock at night right here, and you are tired and want to go to bed, and you say, hey, once this breaks out of this line, I want to get in going long, but I don't want to stay up all night long watching it. So you'll go ahead and place an order right at this line that says, okay, once it hits this line, I want to get in, and I want to make pips as it's on its way up. Let's say I'll give myself a 50 pip take profit level and grab some of those pips. So you go to bed right here, 1 hour, 2 hour, 3 hour, 4 hour. Finally, in the middle of the night, it triggers your order and you wake up having made 50 pips while you were asleep because you placed a limit order with a take profit up here. So stop orders and limit orders are pending orders for the market. They're pending, which means that the market has to move and hit the price you specify for you to get in. Okay, so that's one of the things about entering trades that are a few of the different types of orders for entering trades. On exiting trades, we have a few different options too. We can close at the market price. So right now the market's sitting right here. We can close it and say, oh, I'm on out. Okay, I got in right here, right? And no, wait, I got in right here. I'm up here. I want to get out. Here's my take profit here. Here's my stop loss up here. I got in right here. And so if it comes down here, it's going to close me out with a profit. If it goes back this way, it's going to close me out with a loss, but it's going to protect my capital. And right here's where I got in. And so I can do that. I can close at a market, or I can wait till it's my take profit, or I can wait till it hits my stop loss, or I can use a trailing stop loss where the market climbs up, hit your stop loss, whatever. A trailing stop loss is where the market will follow your trade. It'll keep your stop loss snugged up to your trade a certain amount, however you specify. Let's say you want it to be 40 or 50 pips behind your actual trade. So when the market climbs up 200 pips, it keeps that stop loss 40 pips behind it. It comes back down 40. First time it comes back down 40 pips, it'll stop you out, but you've locked in that profit as you've climbed. So that is the trailing stop, along with the take profits, the stop losses, and different ways to get out of a trade. Okay, so moving on, let's look at and make sure you watch the next video on reading Forex charts. There's some pretty good stuff in that. Good job on so far. Keep with it, and you'll have this thing figured out in no time. Let's take a look at what we have on the next one. See you on the next video.